You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. The Fed's mission to bring inflation down to 2% will be much more difficult if inflation expectations accelerate, based on the idea that people's beliefs about future price changes can be self-fulfilling. Although Fed models believe expectations are shaped by the public's perception of central bank credibility, there's evidence that they are instead formed by people's lifetime experiences, meaning each month of high inflation has a longer-lasting impact, and the Fed is misguided to think the past few years have had a muted effect on inflation expectations. On today's episode, we talk with the University of California's Ulrike Malmendier and the University of Chicago's Stefan Nagel about how lifetime experiences shape economic expectations, the scarring effects of the pandemic economy, and the implications for future Fed policy. Stay tuned. Coming up soon, our interview with Ulrike Malmendier and Stefan Nagel. But first, a quick market update. The headline CPI fell 0.4% in June, while the core index that excludes food and energy was virtually unchanged. The report was significantly cooler than expected and firmed market pricing for the Fed to leave rates unchanged at its July meeting. Fed officials were happy to receive the report, but understandably reluctant to rewrite the inflation narrative based on 1 month of data. Investors will focus on upcoming months of data to see whether the June release was a fluke or representative of an inflection point. The Fed will see the July and August CPI reports before its September policy decision. Retail sales were strong in June, limiting any worries that falling price pressures last month were the result of a collapse in demand. The Fed's latest Beige Book reported decent economic growth across its 12 districts and showed nothing that would suggest inflation decisively turning one way or the other. Meanwhile, the ceasefire between the US and Iran is effectively over, although some officials insist negotiations are still ongoing. Front-month crude oil prices have risen almost $20 over the last 2 weeks, and gasoline is back above $4 per gallon. The Treasury market initially rallied after the CPI and PPI reports before escalating US-Iran tensions and concerns over global sovereign debt caused yields to reach fresh highs. Yields are up 12 to 17 basis points on net across the curve over the last 2 weeks, and most tenors have broken through support as of recording. The 10-year yield reached 4.71% this week, and 2s reached 4.35% for the first time since February 2025. Most of the Fed speak before the pre-meeting communications blackout echoed the familiar message of upside inflation risk and a willingness to tighten policy if prices accelerate in the coming months. Fed Governor Chris Waller, one of the more dovish FOMC participants last year that is now vocalizing inflation concerns, said the Fed should consider hiking if core inflation was hot in June. Those tightening fears were priced out of the market, of course, once the data came in cool, but Waller's comments show how much Fed sentiment has shifted over the last few months. That's all for the market update this time. Now our interview with Ulrike Malmendier and Stefan Nagel. We have two guests for today's episode. First is Ulrike Malmendier, professor of finance at the University of Berkeley. Ulrike, thanks for joining.
It's great to be here with you.
And Stefan Nagel, professor of finance at the University of Chicago. Stefan, thanks for coming on the podcast.
Thanks for inviting us.
Our topic today is how lifetime experiences impact economic behavior, specifically inflation expectations. Now, inflation expectations have this outsized role in models used by central banks and economists because of the idea that if households and businesses believe prices will increase at a certain rate in the future, they'll set contracts accordingly, and those expectations become self-fulfilling. So to start things off, what do these models, I guess we could call them the mainstream models, for lack of a better term, usually think determines long-term inflation expectations?
So the way these models work is they basically have a built-in assumption that people understand that a central bank has an inflation target, around 2%. And that the central bank will do what it takes to achieve that target in the long run. So basically, it boils down to an assumption that people think, no matter what happens in the short run, that in the long run, inflation is going to be around 2%.
Right. So it comes from the central bank's willingness, but also ability to make sure that price increases go to 2% year on year. And what are the metrics that are commonly used to measure inflation expectations? When a central bank, and let's, I'll be honest, our audience is mostly focused on the Fed. So when the Fed is looking at people's inflation expectations, how do they evaluate them?
Yeah, so they look at a bunch of different measures. So there are basically two groups of measures of inflation expectations. The first one is from surveys. So there are surveys of consumers. For example, the Michigan Survey of Consumers has been done for many decades. There are surveys of professional forecasters who work in, banks and other firms, often in the financial sector. And then more recently, there have been also more surveys of decision makers in firms. So those decision makers that actually make decisions about what the prices are in the economy. So there are surveys of those as well. One more set of measures is from market prices. So you can, for example, look at the yield spread between inflation protected bonds and conventional nominal bonds and extract from that a measure of expected inflation. And then also the derivatives called inflation swaps that basically can give you a measure of expected inflation as priced into market prices. And each one of those different measures has kind of different strengths and weaknesses. If you look at professional forecasters or market prices that are set by bond market investors, these are very sophisticated, typically informed market participants. So there are some advantages there. But on the other hand, if you look at who actually makes decisions in the economy, in firms, in households, it's individuals who are not necessarily experts about the macroeconomy and about inflation. So each one of those different measures basically looks through a different lens to try to figure out what people overall are thinking about inflation in the economy.
Yeah, and so I just wanted to add to the last point Stefan made that in your introduction, well, you're saying, well, we're actually starting from caring about inflation, and somehow we're looking a lot at inflation expectations. Why? Because we think that's going to feed back into where inflation actually is. Hence, this whole debate about who are actually the decision makers who put dollars behind their expectations, who think prices will rise and therefore adjust their contracts and what they're willing to pay. And so we economists have been struggling not only with getting the truth out of people, like what do they really think, but then also what are the expectations that impact how prices will be set. And so where we come in with our research, Stefan and I, is to say, that's important. That's the right way to think about it. As Stefan said, it's household and firms who actually make the decisions. But also, if inflation makes you nervous and makes you start being worried about inflation, makes you anxious at how you look at the world, that's important too. And we're going to talk about how that can be very long lasting and can ultimately affect your spending behavior as well. So it's an aspect central banks haven't had so much on their radar until kind of this type of newer research about, different routes inflation expectations can be taking in terms of being formed and impacting decision has come about.
So your research instead concludes that lifetime experiences with inflation shape expectations rather than people walking around thinking, oh, is the Fed going to do what it takes to bring inflation down to 2%? It's what has happened while they've been, economic agents. So walk us through how you arrived at this conclusion and talk about what it means.
My version of the origin story of Stefan's and my research is that we were both walking around at the time at Stanford, where we used to be both professors as well, and both being German, discussing about why the Germans are notoriously obsessed and worried about inflation, famously much more than their European neighboring countries. You're trying to have a joint monetary policy in Europe, and then there's one country that's always extra, with much suspicion looking at the ECB president, whether they're making the right decision or the board, can sometimes lead to friction. So our notion and the notion of many historians and the Germans have just been so scarred by having had this hyperinflation during the Weimar Republic early in the last century. Then the wars came and also the currency became worthless. And that has kind of shaped them. That has kind of had these long-term effects. And so thinking about whether there could be something to that, maybe not quite going back over generations, although we'd love to study that as well at some point, but even within your own lifetime, that if you've lived through periods of high inflation, whether that fear stays with you, that you're starting to think differently and react differently to price changes when you go to the supermarket or to the gas pump and so on. Like you have more of a response. I think motivated by our German background is the origin. And then we just went out and looked in standard data stats. So most of our work has been with US data, such as the Michigan Survey of Consumers and other data sets, whether the answer people give to the question, what do you think inflation will be over the next year or years, or recently over the next 5 to 10 years, can be predicted by inflation they've seen in their life so far. And just to be clear, of course, we account for where the economy is at, what's the current inflation rate, what do we know for in terms of current monetary policy. We account for everything that's known at this point in time. And then we say above and beyond that, if I take into account that you have experienced the 1970s high inflation versus this other person has not, does it tend to give us predictive power? And the answer is yes. So more technically speaking, if you give me your birth year, allow me to calculate, roughly the average lifetime experience of inflation, does that have predictive power in understanding how worried you are, how you think about, how you form expectations about future inflation? And the answer is yes.
Interesting. So it's not only the country that someone has lived in, but also the time periods they've lived in, the certain business cycles or instances of high inflation. And I think this is interesting because I've heard this argument, story, whatever you want to call it, that central bankers who lived through the late 70s high inflation in the US, or they had PhD advisors that lived through it, they were the ones in positions of power after the financial crisis and were so afraid of reliving that episode that they arguably tightened policy prematurely. Does your research say anything about how lifetime experiences affected the perspectives of central bankers themselves?
Yeah, so we have a project where we looked precisely at this question, and we found that these experience effects that we see for consumers, for households, they also show up for members of the Federal Open Market Committee, the FOMC, and we looked at this over several decades. The way we can look at this is that the FOMC has to report every 6 months to Congress in a monetary policy report, lots of things, including the inflation expectations of individual FOMC members. And so we use that data to look at, do experience effects show up? Different FOMC members different in their inflation outlook based on the difference in experiences that these FOMC members have with inflation in the past. And it does show up. So the effects are a little smaller than for consumers, but it's kind of still surprising that even for these, really subject matter experts who get advice from professional staff, you still see this experience effect showing up. We also looked at the voting decisions that they make in FOMC decisions and found that the decisions to dissent either on the hawkish or dovish side from the consensus is also explained to some degree by differential inflation experiences that FOMC members have in the past. And there's one individual that I should maybe mention, which is kind of interesting, who we stumbled on this person in the course of our research. Ulrike mentioned earlier the German hyperinflation. There's one individual who served on the FOMC in the 1970s and early 1980s, Henry Wallich, who was born in Germany and while still in Germany lived through the German hyperinflation in the 1920s, and then later emigrated to the US and then later served on the FOMC as a Fed governor. And he, to this day, still holds the record of the FOMC member with the most hawkish dissents ever. So he was a very strong inflation hawk. That's just anecdote, but we have in the paper, our project found very general evidence that even FOMC members are subject to these experience effects.
So now that we're about 5 years into above target inflation in the US, and there's this question always about what is a transitory supply shock and what is really just the Fed getting behind the curve and they should do more to fight inflation, I think this idea of lifetime experience versus so-called credibility is really powerful because as I see it, every month of high inflation has a scarring impact on anyone alive, even if it's somewhat small in the course of their lifetime. But it also means that policymakers shouldn't be looking to the survey measures we talked about or five-year forward break-evens to see how people have internalized inflation. We shouldn't wait for an acceleration to conclude that expectations have become unanchored, but we also shouldn't be too comforted by these measures moving horizontally. Is that right?
Yes, the way I would put it is it's kind of a glass half full, half empty situation. In some sense, if people's expectations are tied to experiences, since lifetime experiences are sort of slow moving, right? Every individual new observation that someone sees gets combined with prior experiences. So one observation typically doesn't move people's expectations all that much. So this gives some stability to inflation expectations, but only to a certain degree. Once you get through substantial inflation over a prolonged period, then inflation expectations get way out of line with what central bankers would like these expectations to be. Once you're there, then it's very hard to change. Again, because these lifetime experiences are kind of sticky. It's not easy to change people's views when they rely on lifetime experiences. In the recent inflation, the experience dependence of expectations has made things still easier for the Fed because long-term expectations actually didn't move all that much. But if you were to get another wave of inflation in the next years, or maybe another two, and then the situation would look like in the late 1970s. And then it would take a lot of pain, basically, to get these inflation expectations back down.
I have to say, I find this lifetime experience idea a lot more convincing than the idea that your average person is thinking about whether the Fed is doing enough to fight inflation. My friends and family, all smart people, I love them, but I don't think they think about the Fed at all. But I also wonder whether it's lifetime experience or current economic conditions. Do most people internalize inflation the way that economists think about it? I think the last few years have shown that most people complain about inflation, and what they're really talking about is price levels rather than price changes. And so when we think about those survey measures or how people are really having scarred impacts from inflation, are they really understanding it the same way that economists do?
I think there's evidence that many people don't. One thing you can often hear is, why is everything still so expensive when inflation is down? And this kind of indicates that there's some confusion about the rate of change in prices, which we measure with inflation. And I think this also has some implications for why people are unhappy with Federal Reserve policy. Policy has maybe helped bring inflation rates down, but the price level did not come down. That's why we see still some lingering unhappiness and also the discussions about the affordability crisis and so forth.
Yeah, I think it's both, as Stefan said, a certain confusion at times, but also something we economists should take more seriously. We think, okay, if prices rise by 5%, and that's a shock, people are processing that. However, if wages have also adjusted, everything should be good again, right? Like we can afford the exact same things as before. And yet, I think you're exactly right that we still, hear people complain about it, focus on price levels, etc. I certainly remember growing up, like with my dad checking the grocery bills and complaining constantly about, oh my God, bread used to be such and such, and milk used to be such and such. And he could not get over the different prices, as you were saying. There might be more for economists to think about, but partly I think that does point exactly to our research that this experience of the price increased by so much just stays with you, shapes your future beliefs, shapes your anxieties about inflation, no matter what the adjustment in price it has been at this time. And I think we need to be really careful about that and conscious of that. Politicians need to be, central bankers need to be, rather than kind of just thinking whether wages and inflation is in sync or like the rate of inflation has come down. This shock of the higher price level sits with people, and I think that's reflected in our work of lifetime experiences.
And even if we decide that we know much better than these average consumers, they are the ones that are forming expectations that could become self-fulfilling. And so even if they are frustrated for what we consider the wrong reasons, that's really not the point. There is good evidence that people's year-ahead inflation expectations and surveys are driven primarily by changes in gas prices. And these are changes that are incredibly salient to them, even if gas only makes up about 2.5% of the CPI basket. Do you have any sense of whether certain items like groceries or gasoline weigh more heavily in your lifetime experience model of inflation expectations than the broader cost of living? And I want to throw one example in there, getting back to this idea that the scarring impacts don't always match up with the data, which is that some people believe egg prices are still really high, but as far as we can tell, in the CPI, there was that big spike, I think, in January of last year, and they've come down, but it's like people are still scarred by that. And I just wonder if this misunderstanding or misperception of kind of the broader price landscape is going to impact how people shape their expectations.
Absolutely. We found that how often you see a price increase matters more than how big it is, whether you need to get a new car that costs 5% or 10% more post tariff. So who knows how much. It's a one-time expense. It's kind of really heavy. You're going to really have to think about how you can pay for it, etc. But if you compare that with going to the grocery store twice a week or 3 times a week and like seeing these egg prices you alluded to, or the milk prices, etc., just kind of changing over and over again, increasing over and over again. And by the way, sometimes they decrease. In research by other researchers, it has been shown that we tend to latch onto these price increases and don't put too much weight on the decreases later. So these highly volatile prices, which we see, such as food, such as gas, tend to influence us a lot because we see many, many instances of increases. And you can think about it as if in your head, you're kind of taking an average of all these increases, kind of equal weighted. It doesn't matter how much you're paying for it. It just matters how often you see them. And if you're averaging that out, you can see how people who do a lot of grocery shopping or like have to do a lot of driving and go off to the gas pump get very worried about these types of prices. So the bottom line is, yes, gas and food has an overproportional influence on our inflation perception, regarding current inflation, but also inflation expectations looking forward. And if you want to trick yourself a little bit into kind of ameliorating that, if you just reduce how often you go shopping, for example, that can help, because it's just kind of less often that you get the little shock of, oh my God, the prices increased again. And that, by the way, ties back to what you said before, Will. It doesn't matter if we tell people, look, that's wrong. You need to divide by how much you're actually weight, by how much you're actually paying for that. This is a minimal amount in your consumption basket. That's just how people form inflation expectations. And that's relevant for the Fed, which rightly says when we try to predict future inflation trends, if anything, we take gas and food out. That's not part of core inflation because it's too volatile to really clear the picture here. Well, it turns out that exactly those pieces you're taking out are the ones consumers are a lot focused about, a lot influenced by. And that's the reason why we should more time understanding how much that influences individual perception.
Inflation expectations, I think, are important no matter what, because as you said, this is a big part of Fed models and economist models, and the Fed is the one that makes monetary policy. It's not any of the three of us. But there are instances in the last 50, 60 years where those measures of long-term inflation expectations, whether it's the 5 to 10 years ahead component in the University of Michigan survey or 5-year forward break evens, they didn't seem to be a predictor of future inflation at all. So even if inflation expectations are formed in the way that your model theorizes, does it prove they are self-fulfilling, or is this just a totally different topic that is outside the scope of your research?
I think our research does connect to this question of whether expectations are self-fulfilling, but our research alone doesn't give you the full picture. So in some sense, you can think about here two mechanisms being important. One is what kind of information feeds into inflation expectations, and most importantly, does realized inflation feed into higher, inflation expectations? And then the second mechanism is, how do higher inflation expectations lead then to actual changes in price setting, in wage determination, and so forth? Expectations of inflation then get translated into actual higher inflation rates. And our research basically looks at the first link in that chain of how do realized inflation feed into expected inflation. And then there's lots of research done by others that looks at firm price setting, wage determination, and so on, to try to understand what determines that and to what extent expectations of inflation play a role there.
I want to take a step back and really think about how this lifetime experience framework can affect how we think of economic behavior. So many of our models are based on the idea that people spend, save, invest, hire, whatever, because of how their current situation looks. Now, some models throw in expectations there, so there's a future aspect of it. But you're saying that people are shaping their economic decisions not just based on current circumstances or what they expect to happen, but also what has already happened in the past. So, outside people's lifetime experiences with inflation, what are the other non inflation economic indicators you've found correlate more with lifetime experience than current situation?
Yeah, so in fact, our very first piece of work together, our research together, was not on inflation, even though that was the motivation, the German motivation, but it was on the stock market. Both of us got confronted here in the US with this notion of depression babies, of how the generation who have lived through the Great Depression is forever scarred by that experience, and particularly avoids the stock market. We have a quote that all things risky like the plague. And so we looked at whether that's the case, and not actually just for the Great Depression, but in general for periods of ups and downs in the stock market, and whether that can predict whether people are willing to invest at all in the stock market, which we all should in a broadly diversified way. And the answer is yes. Whether or not you're a stock market participant and how much of your liquid wealth you invest in the stock market is strongly predicted by how well the stock market has performed in your life so far. And it was really neat is that in this related research compared to our inflation research, the way people's lifetime experiences enter is very similar. I mean, obviously, we put a lot of weight on what happened recently this year, the past few years, but even stuff far back, early in our life can matter. There's kind of roughly linearly declining weights. It decreases, kind of going back to birth. But the shape of this function is quite similar. So there was this research on stock market investment. We talked about inflation with a former student who's at the Boston Fed now. I've looked about what unemployment experiences do to you, whether they shape you, if you've kind of lived through these periods where either you personally, your family personally, or in your area where you live, there was a high unemployment. It makes people more cautious, more cautious savers, accumulate more wealth, actually, ultimately, because they put money aside. I mean, this is all in the economic realm. Maybe I'm going further than Stefan would. Stefan can rein me in, but like I think this kind of mechanism the two of us have found about how personally living through realizations of important variables, macroeconomic variables, microeconomic variables in the labor market, in the stock market, in inflation, affects how you look at this area, at this market, and shapes the way you form expectations going forward and make decisions, obviously, right? Even in the inflation realm, we haven't talked about that. It's not just about expectations, it's about what type of mortgage you choose. Do you want to buy a house or not? How do you want to protect your money's value? I would say we think that's quite universally applicable. And I think it reflects what we learned from our colleagues about in neuroscience, about how our brain changes as we walk through life, right? We get rewired, we get particularly attentive to certain types of signals. And that's just not undone by the Fed announcing a target or by policymakers making decisions that will do something in shaping the stock market. It will just stay with us. So we think it's quite broadly applicable. I mean, going beyond what we have worked on, thinking about how big crisis experiences like living through COVID might shape our perception of how we interact with others and how we think about socially being together, how society hangs together. We're both parents. I think that's something we've worried in our children about, and actually more broadly, maybe people are worrying about in terms of increase in polarization. So that's not our research, but I just kind of want to lay out, it's not implausible that this affects all realms of our personal experience.
I want to end then talking about how the last 5 or 6 years might impact people who have lived through this pandemic economy moving forward, because people have experienced all sorts of economic extremes since the spring of 2020. It's one thing to talk about the high inflation of the late 70s or the depression babies, where there's this one really big economic indicator that went to the extreme and everything else was maybe less intense. But think about what we've gone through the last 5 or 6 years. There was a huge unemployment, in the spring of 2020, and then the tightest labor market in 50, 60 years. We had people, really worried about being able to pay rent and their household finances to the point where then wealth was, to an extreme high with confidence. What do you think will leave the greatest impression on people who lived the last 5 or 6 years?
From our perspective, if we tie all of these pieces of our conversation together, right, we would first say, in which areas where did people experience the biggest impact? And you listed some of them. Implicit in what you listed is also that, for example, the stock market didn't have another dramatic tumble. COVID came with a little bit of a dip of the stock market initially in the US, but then not much, and has been doing great. So for starters, this kind of depression baby story where it was around the stock market, we would not predict to see. So we would expect there not to be a particular dip. But inflation, definitely. So inflation really climbed post-COVID into very high realms towards the double digits again. And that didn't last as long as in the 70s and 80s, but it is there. It is still not coming down. In particular, maybe if another increase happens with tariffs and other policy measures, we would expect there to be a long-lasting effect. And that's also something that people see every life. I mean, as we discussed earlier, when doing the groceries, when purchasing all sorts of items. So the notion that this inflation experience is what really shook people up, in particular after this long period, as Stefan said earlier, of low inflation before, is probably, Stefan, I would say our prediction influenced people most from the experience effects perspective.
I would agree with that. And I would add that, Will, some of the things you have mentioned, like unemployment, or, Ulrike mentioned the stock market. For unemployment in the stock market, people have gone through a quick reversal, right? So unemployment was high, but then came down a lot, and there was a labor shortage. The stock market went down, but quickly came back up, and there was not the AI boom. And so given this big reversal that people also experienced, there's probably not going to be much of a long-term effect of the initial, dip. But inflation in that sense is kind of quite special because, people came into this period with experiences of always low and stable inflation over a long period of time. And now this burst of inflation, and there was no, reversal, right? We didn't get a subsequent period of deflation that would somehow offset this in people's experiences. So I would agree with Ulrike there that inflation is probably the special one here that will have a particularly long-lasting effect on how people think.
Ulrike and Stefan, thanks for coming on the podcast.
Thanks for having us.
Thanks for having us.
That was Ulrike Malmendier and Stefan Nagel. I think there are a lot of good points there that help us understand inflation expectations. One thing is that consumers internalize price increases whether the cause is a one-off shock or the result of economic fundamentals. Another is that food and energy prices, which the Fed and economists often exclude from inflation measures because of their volatility, are highly influential in shaping expectations because of their saliency to consumers. And lastly, price increases have more of a lasting impression than price declines. So even if a price returns to its original level, the increase will stick with people more than the decrease. The Fed is widely expected to leave policy unchanged next Wednesday. Although this meeting is not scheduled to have a new summary of economic projections, there's an ongoing chance that Kevin Warsh will implement other changes that reduce and revise the scope of Fed communication. This could mean an even more concise policy statement than the June meeting, or a much shorter press conference. Warsh may also choose to share new information on the 5 task forces he announced last month. The next day, the June PCE and advance release of Q2 GDP will provide the latest update on prices and economic activity. The core PCE deflator is expected to be benign considering the already released CPI and PPI, while growth is expected to have remained solid through the 3 months of elevated energy prices. The Atlanta Fed's GDP now is currently tracking 1.7% GDP growth for last quarter. The following week, the ADP and ISMs for July, along with the June JOLTS report, will set the tone ahead of the July jobs report on August 7th. Last month's labor market data were broadly weak outside the 4.2% unemployment rate, which happens to be the Fed's preferred metric for gauging labor market tightness. So far this year, the resilient labor market has permitted the Fed to prioritize inflation risks. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.